So hi everyone, welcome back to my channel All-in-One Education. So today we are going to continue our financial accounting series. In our very last video we solved exercise 26.11a. Today we are going to start a new chapter, number 27, and the first question we have is 27.1, which is related to depreciation. So I'm making this video after a very long time because I was busy in my exams, so sorry for that. So I hope you guys remember we have already covered three depreciation methods: straight line method, unit of activity method, and declining method whose other name is reducing balance. So first let's read the question and try to understand what it is trying to say. 27.1, a company starts in business on 1st January 20x5. You are to write up the Vans account and the provision for depreciation account for the year ended 31st December 20x5. From the information given below, depreciation is at the rate of 25% per annum, using the basis that one complete month's ownership needs 1 month's depreciation. 20x5, bought two vans for £6,900 each on 1st January, bought one van for £7,200 on 1st of August. So they have bought three vans in total, two on 2nd January and one on 1st of August. So what we have to do? We have to create ledger accounts for vans and the provision for depreciation. Now, if you are wondering what is provision for depreciation is, it's the total amount of assets depreciated within the given time or date, you can say. Now, let's start creating ledger accounts. As you can see, I have already prepared the structure. There are two ledger accounts, one for the vans and the other for the provision for depreciation of vans. And this part is for calculations. So according to the data provided, the company bought two vans on 2nd January for £6,900 each, which means for two vans it will going to be £13,800. Vans are assets, so we will write down this entry in the debit side of the ledger. Let's first write down the headings. So the first ledger account we have vans and the other provision for depreciation vans. And this side first we will write year, which is 20x5 in both the accounts. And in the first column of vans we have to write the date, which is 1st January, bank. £13,800. The transaction medium is not mentioned, whether if it is going through check or cash. So when there is nothing mentioned, we take it as a bank. Now for provision for depreciation, we need to perform some simple calculation which I am going to show you. According to the data provided, the company bought two vans for £13,800, right? And the annual depreciation rate given is 25% annum. So we are going to calculate 25% of £13,800. If you are using a simple calculator, then you first need to convert this percentage into decimal, which means divide the percentage with the 100 and you will get your decimal value. How? I will show you right here in the rough work. Like if we have 25%, then you simply need to divide 25 by 100. So you will get your decimal value, which is 0.25. So after conversion, simply multiply with the amount, which means 0. And don't forget the asterisk. 0.25 into 13,800. Okay, if we multiply this, which is equal to 3,450 pound. This amount is the total depreciated cost of those two vans for 1 year, which the company bought in. Now for the third van, as you can see, they've also bought another van on 1st of August for 7,200 pound. Now for the third van, multiply 0.25 with 7,200. So what we will get if we multiply 7,200 with, so we get 1,800, but this amount is of 1 year because the rate 25% given was of complete 1 year. If you take a look on the question carefully, they said that the company bought this van in August and we are making ledgers till December, which means the third van is only 5 months depreciated. So to calculate the depreciated cost of 5 months, simply divide the 1,800 with 12. 1,800 into 12. We get depreciated cost of per month, and now multiply with 5 to have depreciated cost of 5 months. Now if we multiply 150 with 5, this 750 is the depreciated cost of the third van for 5 months. If I have to write this over here, we can simply write this in the form of multiply 5 divided by 12. This is how you can write this. Now add all three vans cost, we get our provision for depreciation. Now we simply have to add these two. So we get 4,200 pound. We will write this in the credit side of the provision for depreciation, and the date we will write is 31st December. Profit and loss, because this will going to be used in profit and loss account, 4,200. Now let's just calculate the closing balances of both. First of all, closing balance of, oh, we didn't mention 1st August entry of third van. Bank, and the amount was 7,200 pound. And in the credit side, for the closing balance 31st December, balance C by D, and if we calculate the total amount of the debit side, add 13,800 into 7,200, we get 21,000 pound. So the balance will be 21,000 pound. Same goes with the provision for depreciation. 31st of December, balance C by D, 4,200 pound. That's all for today. I hope you have understood this question. See you in the next video. Till then, take care of yourself, subscribe to the channel and hit the bell icon so that you get a notification of the upcoming video. Bye now.